So if you had your doubts about Twitter going public, oh boy, just wait. Flash sales site Zulily is now eyeing its own IPO for a whopping $100 million. It is a pretty hefty number, considering it only posted a profit of a little more than $2 million for the first half of the year. Is it just me, or is this turning into an IPO free-for-all? Hedge fund manager and Fox News contributor Jonathan Hoenig is here, and tech startup investor Amish Shah joins me now as well. Jonathan, let me start with you. I mean, some of the companies that are looking to go public, they're saying after Zulily, we can see Gilt Group, One Kings Lane, Rue La La. I've never even heard of this. What is going on?
This is capitalism, Melissa. This is a good thing. These are speculative but promising new enterprises raising money from voluntary investors to fund their businesses and perhaps go on to be the next eBay, the next PayPal, the next IBM, who knows, the next Apple. So I wouldn't consider this to be 1999. You seem to allude in your question, perhaps this is a frenzy, a bubble like 1999.
Yes, that's exactly what I'm asking, is this feels very bubblicious.
I remember that era. Yeah. I remember that era. I just don't think we're there, even though the fact that a lot of these companies, Twitter among them, isn't making a lot of money right now.
A lot of money, or any money, actually. I mean, they aren't making a profit. Amish, I look at Zulily and make fun of the fact that, they're making $2.4 million in the first half of the year, but that's more than Twitter in profits. So I don't know. What do you think? Is this insanity, or is this capitalism at its finest? Go ahead.
Absolutely. It's definitely, I have to disagree with you a little bit, Jonathan. I think, 1999, I think it's a repeat. It's like Groundhog Day all over again. I mean, if you look recently, we've heard Candy Crush going public.
Right.
I mean, are you kidding me? A game like that's going to be out there. So, Melissa, I think, at all due respect, it's okay. I am for capitalism as an investor.
Yeah.
But if lots of risk in what Zulily is doing, I think there's better plays out there that are going to be going public, like Square, another company Jack Dorsey's part of, the founder of Twitter, Palantir. So I think that there's a lot better plays out there than a Flash site. I mean, they should learn from Groupon, right? I mean, if you look at Groupon, it was a total bust.
Groupon, I mean, Jonathan, it does seem like we get irrationally excited about a lot of these companies. I mean, for example, everyone gives Apple such a terrible time. Will they ever have the next big thing? And they still love Amazon. But if you look and compare the two, I mean, Apple in the last, just at the end of 2012, in the last quarter, they made $13 billion. That's more than up to that point Amazon had ever made in profit in its whole entire life of being a company. Yet we love Amazon. It seems like we look at these things irrationally sometimes.
Well, I mean, stocks are forward-looking indicators, Melissa, and just because you have a profitable company doesn't always mean you have a successful stock. And just look back to a lot of the dot-com era or the internet era stocks of 10 years ago. Even though they make more money now, a lot of them, and Cisco comes to mind, actually trades at a lower price than it did 10, 15 years ago. Because when you buy a stock, this is to Amish's point, you're buying a valuation. So although I'm not investing for my clients over at CapitalistPig.com in Twitter or in Zulily, the fact that they are able to come public shows that there is a risk appetite out there, and that's a positive thing for the markets.
So, Jonathan, did you just say that you wouldn't buy any of these?
I don't buy IPOs. I prefer to wait and actually see how a stock plays out. I mean, these are sales to the public, and especially when you have such high-interest, pop, almost cult stocks like a Twitter. In my experience, it's usually best for most investors to stand to the sidelines, at least at first.
Amish, what do you think?
I'm going to, again, take a little contrarian opinion here, I believe, is that, I had a chance to get on Twitter on the secondary market, as a lot of other investors do. That's a hot thing these days. So it's not just the IPO. You could get in on the secondary market. I think I was able to get in at 20 or 22. And I think, I kick myself now because if you look at the Vegas odds, I think they have them at 35 last I checked that they will go public. And if we're talking about Twitter, I think on the first day, something about $55. So that's a 2x return. And I think Jonathan will agree that that's not a bad return for your fund there. Wouldn't you agree, Jonathan?
I mean, unless something like Facebook happens and you see the stock go down, down, down out of the gate. I mean, are you going to sell on the very first day if it comes out at that? Just, wipe your hands of the whole thing at 55 and get the hell out? Amish?
It's interesting, Melissa. Here's another one, and a lot of people that know me. Back when it was 17, talking about Facebook, back November, I believe, of last year, I was sitting at a meeting with a lot of hedge fund managers, and I was telling them a buy. I actually did get in on the IPO at Facebook, and I held on, and I'm happy. If you look at the returns again in a year and a half, I mean, what are they at? They tipped over 50 last week. I think they ended at around 46, 47 today. So if I look at it that way, I was one of those that felt like Facebook had a good model, especially with everything they're doing at mobile. And I believe there's a chance that, they could actually be close to what LinkedIn's doing right now in the next year or two.
Well, and I'm delighted that Amish has done well with his investments. I've done well with a lot of mine as well. But keep in mind, Melissa, there's a difference between a company and a stock. They're two different things. A lot of times, even great successful companies, the stocks ultimately end up disappointing, and that's especially true when you buy them at a high valuation.
Okay, you guys were great. Thank you so much.
Thanks, Melissa.
Thank you.
Thanks, Jonathan.
Up next, the ultimate try before you buy. A new trend happening in the housing market is to actually stay in the home you're considering buying. Test it out. Stay overnight, a sleepover. Do you think it would make you more or less likely to pull the trigger? We've got one developer who did it himself. He's going to tell us if it's really worth it. Should you let people do this in the home you're trying to sell? Do you ever have too much money or too much information?
Live at the Forbes Healthcare Summit, Emacs diagnosing the opportunities, consulting with top CEOs in the sector to give you a health